All right, let's get ready for a main event. Today, we're pitting two of the market's biggest heavyweights against each other, the S&P 100 versus the Nasdaq 100. This is the ultimate showdown, stability versus speed. And by the end of this, you'll know exactly which one packs the bigger punch for your portfolio.
You know that feeling, right? You look at your investments and it's a total roller coaster. One month, you feel like a genius because your tech stocks are going to the moon, and the next, you're just staring at the screen wondering what on earth just happened. Well, that exact feeling, that's at the very heart of what we're talking about today.
Because in one corner, we have the stable titan, the S&P 100. These are the established powerhouse giants of the American economy. And in the other corner, we have the growth engine, the Nasdaq 100, the home of breakthrough innovation, disruption, and just pure high-octane growth. So let's get into it.
And welcome to everything you need to know about finance. Now, before we really get into the nitty-gritty, just a quick heads up. This is a deep dive for informational purposes. It's not financial advice. We're just here to break it all down for you.
And hey, if you find this kind of stuff interesting and valuable, taking a quick second to like and subscribe makes a huge difference. It really helps us create more of these explainers. Okay, now let's get to the main event.
All right, for round one, we're popping the hood. We're going to look at the DNA of these two indexes. Because to really get what makes them tick, you have to understand what companies are actually inside them, and more importantly, why. That makes all the difference. First up, the S&P 100. The best way to think about this is like it's the A-list from the already A-list S&P 500. It's a curated group of the biggest, most established, most financially sound companies in America. And the key word to remember here is sector balance. It is specifically designed to give you a really broad look at the leaders across the entire economy.
Now check this out. What's so telling about this slide is just how diverse it is. Yeah, you've got a big slice of technology, of course, your Apples and Microsofts, but look at all the other major pieces of the pie. You've got big banks in financials, healthcare giants, and the bedrock sectors like energy and industrials. This diversification, that is its number one strength.
And now for its rival, the Nasdaq 100. This one also tracks 100 of the biggest companies. But there are two game-changing differences. First, they all trade on the Nasdaq exchange. And second, and this is absolutely crucial, it kicks out all the financial companies. It excludes them. And that move deliberately tilts the entire index towards tech and innovation. And boom. This slide says it all, doesn't it? Just look at that chart. That gigantic slice is technology. It completely dominates everything else. Sure, you see some consumer companies and communication services in there, like Amazon and Meta, but you see practically zero banks, no energy, no industrials. This isn't a snapshot of the broad economy. This is a highly concentrated bet on the future of tech.
Okay, so we know what they're made of. Now let's jump into round two and see how this actually plays out in the real world, in the performance arena. This is where their completely different personalities really start to show. So here's the core difference in a nutshell. When times are good, in what we call bull markets, when investors are feeling optimistic and willing to take risks, the Nasdaq 100 often just takes off. It catches every tailwind, like the massive AI hype we've seen lately. But when fear creeps into the market during bear markets or recessions, the S&P 500 tends to be way more resilient. Those stable, dividend-paying companies in sectors like healthcare act like a cushion.
This chart gives you a perfect snapshot of what that looks like in a strong tech year. As you can see, the Nasdaq's focus on growth can lead to some pretty incredible gains. In this case, it's up 25% compared to the S&P's 15%. But, and this is a big but, it's a double-edged sword. In a down market, that same concentration means the Nasdaq could hit twice as hard. It's the classic story, higher highs, but also much lower lows.
And that performance difference leads us directly into round three, the risk equation. Because let's be honest, returns are only half the story. You have to understand the kind of risk you're taking on to get those returns.
This table just lays it all out, nice and clear. Volatility, way higher in the Nasdaq, those big price swings. Drawdowns, which are those painful drops from a peak, they're much, much deeper in the Nasdaq. Tech concentration, we saw that, it's off the charts. Income from dividends, the S&P 100 is the clear winner there. And here's a huge one for the world we live in now, sensitivity to interest rates. High growth stocks are super sensitive to rate changes, making the Nasdaq way more vulnerable on that front. You know, this quote just sums it up perfectly. Investing in the Nasdaq 100 isn't just buying stocks. It's making a supercharged or leveraged bet that the future for technology is going to be incredibly bright. When that bet pays off, it pays off big. But when it doesn't, the pain is also magnified. So after all that, who wins the showdown? The stable titan or the growth engine? Well, what if I told you that's the wrong question? What if the smartest move isn't to pick a winner at all, but to make them work together? Let's talk about the pro move, the team-up strategy.
A lot of professional investors use a strategy called core satellite, and it's actually beautifully simple. You build a foundation, the core, of your portfolio with the S&P 100. That's your stable base, diversified across the biggest and best companies in the economy. Then you add the Nasdaq 100 as a satellite, a smaller, more targeted position that acts as your growth engine, designed to capture that explosive, innovative upside.
The real genius of this approach is that it lets you get in on major trends like AI without having to bet the farm on it. You get the stability of the core combined with the firepower of the satellite. And best of all, you're no longer forced to try and perfectly time the tech market, which, let's be real, is next to impossible.
Okay, let's bring it all home for the final bell. After this whole showdown, what's the one thing you absolutely need to remember?
This slide really puts a bow on it. With the Nasdaq 100, you've got higher potential rewards, but you're also signing up for higher potential pain. With the S&P 100, you're getting a much smoother ride, with still really strong growth from established leaders. The key takeaway isn't to choose one over the other. The smart approach is to use them together, adjusting how much you have in each based on the economy and your own personal comfort with risk.
And that leaves us with one final big question to think about. Looking ahead, what's next? Will changing interest rates reignite the Nasdaq's dominance? Or will the next wave of AI actually favor the S&P 100 giants who have the capital to build it? The balance of power between these two is always shifting, and honestly, that's what makes all of this so fascinating.
So if you enjoyed this deep dive, we've got a whole library of episodes breaking down everything you need to know about the world of finance. Be sure to check them out. Thanks so much for tuning in.